Hello students, welcome to Prudential Business. So students, today we will be discussing about financial management. Okay. So this chapter is as per CBSE Board of Business Studies class 12. Okay. So here what we will be learning in this chapter, let us discuss in details beforehand. Okay. So now we will be discussing briefly about the various concepts or topics that we will be getting to know in this chapter. So the first thing we will be discussing is about the concept, role and objectives of financial management. See, whenever we talk about financial management, we need to refer to these three decisions. Number one is your financing decision, number two will be your investment decision, and the number three will be your dividend decision. Okay, so that is actually the concept of financial management. Usually there is a difference between finance and money. We will be discussing that in the next slides, and also we will be discussing about the role and the objectives of financial management. Usually where are the activities where financial management can be applied or deployed. Okay, we'll be discussing that in details, and next we'll also be discussing about the concept of objectives of financial management. Usually the first objectives of financial management is wealth maximization. However, there are other types of objectives, we'll be discussing that, but primarily the objectives of financial management of every company, whenever it is the financial management is deployed, the first objective of financial management is the maximization of wealth of the shareholders. Okay, so next we'll be discussing about financial planning. There is a difference between financial management and financial planning. These 2 points, or especially these 3 decisions, usually comes under the purview of financial management. But financial planning, this is somewhat much bigger or wider scope than that of financial management. This financial planning, that is actually a sequence of steps in a chronological order, starting from the amount of funds that your particular business requires, then preparing a financial statement, then going to deciding from where to raise the funds, and also utilization of funds and how the firm is going to distribute the amount of profits that they make. All those things will be discussed under financial planning. Okay, and next we'll be discussing is about the concept of capital structure. So capital structure means what? Usually capital of a particular firm is bifurcated into 2 parts. That can be your equity and that can be your debt. If a firm has got a capital of rupees 1 crore rupees, then all the amount of 1 crore must not be raised, or it may not necessarily constitute by one source. Okay, usually a firm has capital structure mainly from various sources. It can go it can raise the amount of funds either by taking a loan from a bank, or it can raise the amount of funds by issuing of equity shares, preference shares, debentures, bonds, etc. Taking a loan from a bank or any other financial institution constitutes your debt capital, and raising of funds by issuing of various shares, usually equity shares, that constitutes your equity funds. So this capital structure is actually a mixture of debt and equity. Out of a particular amount of capital, take for example the capital of a particular firm is 1 crore rupees. Out of this 1 crore, what is the percentage amount of debt? What should be the percentage amount of equity? That thing must be analyzed beforehand. So we are going to discuss in details in the coming slides about the concept of capital structure. Okay, and also the amount of factors affecting it. So what are the factors that should be considered while deciding about the financial structure of a particular company? If whatever be it your whatever be it your capital, whatever be the amount of your actual authorized capital, or whatever be the amount of your paid up capital or issued capital, whatever may be, what percentage of that amount of capital will be raised by issuing of equity, or what percentage of your capital structure will be raised by taking a loan from the bank? All these things will be discussed, also will be explained in the chapter financial management, and last we'll be discussing it about the concept of fixed capital and also working capital. Okay, so fixed capital and working capital. So fixed capital are those amount of capital that will be required by a particular amount of company for more than a period of 1 year. And working capital requirements of a firm basically requires to maintain their fixed activities, fixed assets, like maintenance of your machineries, paying of electricity bills, or those types of activities, or those types of areas of expenditure where even though the firm does not work, it is required to be incurred. So those things, in order to maintain those things, from where the firm is going to acquire, we'll be discussing that, okay, along with the various factors that are also affecting it. Now whenever we talk about fixed capital and working capital, the fixed capital will be those which can be also be acquired by issuing of equity shares, or also by taking short-term credits from a particular bank. And for maintaining of working capital, usually working capitals are required to maintain fixed capital. Take for example, a fixed capital expenditure is of a particular machine, is of buying a particular machine. To maintain that machine, whatever activities are required, just like you're paying off the electricity bills of that machine, or maintenance charges, or regular payment of salaries to the employees, all those things will be discussed under maintenance of working capital or working capital management. Okay, so all these things will be discussing in details along with the various factors that are required to be considered in order to manage both fixed capital and also working capital. Okay, so basically in this chapter we will be discussing all those phenomena. Okay, so usually the chapter is quite long, and so it will not be possible to complete the entire chapter in one video. So I will be dividing the entire chapter into various videos, and I will be uploading all those videos in this channel, in this YouTube channel Prudential Business, under the playlist Financial Management. Okay, so now the first topic of financial management, today I will be just discussing the introductory part of the concept of finance, money and financial management. Okay, here you see first thing, money is required for carrying out business activities is called business finance. Money that is required for carrying out business activities. Now what is a business activity? Take for example, I have my mobile phone or I have my laptop. If I sell my laptop in OLX, or if I sell my laptop to a friend because of some issues, then will that be considered as a business activity? Obviously no. Business activities are those activities which will be utilized for a regular period of time, or it can be my primary source of income. So only those activities will be considered as business activity if it is maintained or if it is carried on for an extended period of time, right? So money that will be required in order to do businesses, that will be called as your business finance. Okay, now you see the business finance is not the amount of money that the amount of money that is there in your hand, or the amount of cash that you have in your bank, that we can be remaining idle. That is the amount of money which a business may not even require, or that is the amount of money that you are utilizing it for your own personal cause, or for your any other emergency purpose, for your dependents. That is not the case with that of your business finance. To conclude a comprehensive meaning of business finance, it will be the amount of finance that a particular business requires, from where it is going to acquire that amount of funds, how well it is going to utilize that amount of funds, and how well it is going to repay back the amount of funds. All those activities comes under the purview of finance, and a regular process of maintaining that finance will be called as financial management, right? I hope this is clear to you regarding the regarding the concept of money or cash and finance or business finance, and also the concept of financial management. I repeat, the concept of financial management will be a regular source of activity. Regular source of activity of what? Of acquiring a particular amount of money that the particular business demands. After the business acquires that amount of funds, the process of utilizing that amount of funds, how well it is going to utilize it, that is called actually an investment decision. And after the business utilize that amount of funds acquired, how well it is again going to repay back the amount of funds from wherever it has acquired. All those things, maintaining of all those things, or the money utilized in doing all those activities, that only will be called as your finance, and that activities will be called as management. Together we will be calling it as management of finance, or together we'll be calling it as financial management. I hope the concept of financial management at the beginning is clear to you, right? So here next you see, finance is needed to establish a business, to run it, to modernize it, or to expand it, or to diversify it. For all those activities, business will be required. However, we will be discussing in the coming slides about the specific role or areas where financial management are usually deployed in any businesses. Okay. Next you see, it is required for buying of whole variety of assets. They may be tangible or intangible, like machineries, factories, buildings, offices, or intangible like your trademark, patents, or technical expertise, etc. Now you see why finance is required. It is required for buying any tangible assets like your machineries, factories, buildings, lands, etc. Along with all those tangible activities, also it is required to maintain, that means business finance is required to maintain intangible assets or intangible properties like your trademark, patent, technical expertise, etc. So see, financial management is also utilized not only in the cases of your tangible assets, but also it is required for maintaining of intangible assets like that of your patent, trademark, etc. Intangible assets can be your those assets which are not seen or which cannot be touched. Trademark is actually a license, or it is a property that gives to the owner of the manufacturer to have exclusive right over that assets. Or patent or technical expertise, these are certain knowledge. Even goodwill also. If a shopkeeper or if a trader is good to his employees, or if a trader maintains all the laws, and if he pays to the business, or if he pays to the government all the municipal taxes, or whatever taxes, legal local taxes, also if he pays regular salaries to his staff, and if he is good in maintaining a good relationship with his customers, obviously he is going to have a very good reputation in the market. So in order to maintain that reputation also, business requires finance, and for that purpose whatever finance the business required, that will be called as financial management. I hope this is clear to you. Next you see, financial management is the activity concerned with planning, raising, controlling, and administrating the funds used in the business. So whatever the business requires, the amount of money exclusively for the business, like for planning of business activities it requires amount of funds, then raising, controlling, and administrative of funds, it requires finance. So for all those purpose that the amount of money that a particular business requires to do whatever types of activities, it will be called as your financial management. Next you see, it is concerned with optimal procurement as well as usage of funds. Not only the funds that the business will acquire it from any source, but it is also concerned with optimal procurement. Optimal procurement, that means it is more than sufficient. Okay, that means it should not be unnecessary. If a business wants, or a business demands funds of rupees 1 lakh, to that extent only it must be able to raise it, and to that extent only it must be able to utilize it. It should be utilized in such a way so that there are no funds that remains idle. Okay, here you see, it aims to ensure availability of enough funds wherever it is required, as well as avoiding of idle funds. So that is called optimal procurement. Whenever we say that the business has optimal procurement of funds, we usually refers to that a business gets those amount of funds to the extent that it demands, to the extent that it can acquire well, to the extent that it can invest well. Okay, so that there is no funds that is remain as unutilized or as idle funds. Okay, I hope this is clear to you regarding the concept of financial management. So in the next slide we will be discussing about the role and the areas of financial management. I hope this is clear to you. So please do stay tuned with Prudential Business. Thank you very much.